Hey everyone, I am here today with Troy. We're going to be talking about the basics of tax deductions for landlords. This is the first tax session of the entire Tax and Legal Summit. So, really excited about this to kick this off. But before we do, if you want to purchase these session recordings for the entire summit, everything except for the VIP recordings, you can go to recordings.taxandlegalsummit.com and you can purchase them there. But Troy, go ahead and introduce yourself for our audience. Who are you? What are you all about? And we'll go from there.
Thank you, Brandon. Thank you for the introduction, and I am excited to be the first person. So hopefully, I hit it off or with good open arms for everyone and get everyone excited about real estate and the Tax and Legal Summit in general. So my name is Troy Silfies. I've been at the Real Estate CPA now for a little, getting close to a year. I've been in CPA for in the CPA firm and world for over 10 years. Really enjoyed real estate. It's very, very lucrative. We'll get into in a little bit. So I'm excited to be here today and talk with all of you.
And you are a tax manager at the Real Estate CPA, and Troy is definitely a go-to guy at the firm. So I wanted to make sure that he had a session slot here that he could show off his knowledge. So Troy, let's start with an easy softball question here. Why is real estate so beneficial from a tax perspective?
Real estate is very beneficial in many ways. So it's a softball question, but it's definitely somewhat convoluted. So what I will say is there's a lot of lucrative opportunities in real estate compared to most industries. There's not that many, but real estate allows a lot of tax deferring options and tax saving opportunities. So there's simple ways for the income tax side, but also real estate income is usually not subject to self-employment taxes or payroll taxes. So that's one way around it. Another great way is hitting the real estate professional status. And I won't maybe go through all those details right at this moment, but hitting that status can really open up a lot of opportunities for you. Just to hit some notes, the other main items for tax deferred, you can do 1031 exchanges or like kind exchanges. There's also another unused or not as used section 721 exchanges. There's qualified opportunity funds and zones. Even personally, just in real estate, you have your Section 121 exclusion. So that's your personal home exclusion for your personal home that you sell and have gains. So there's a lot of different deferred and tax deferred options, tax saving options, as well as we need to get into the deduction side. We'll get into a bit. Cost segregation studies and bonus depreciation that is allowed. So there's a lot of many lucrative ways within real estate that kind of opens up the world to you and to real estate investors to really tax plan.
And a lot of those ways we're going to be discussing throughout this tax and legal summits. You mentioned a lot of things that are future sessions. So we're really excited about that. But you did mention one thing that I want to hone in on a little bit. You said that rental income is not subject to payroll taxes, self-employment taxes. Talk to us a little bit more about that. Like what's the implication of that? Why is that a good thing?
Well, just to go off it is obviously that's some very decent savings. So just say you have a construction business. So let's get outside of the real estate industry, and you have that income is being passed through to you. Let's say it's through a partnership that gets passed through to you, and that's going to be subject to self-employment taxes. So you have to play the employer side and the employee side. So you have 6.2% for Social Security, both sides, employer and employees, so times that by 2, and 1.45% for Medicare. So that's about, I think it's 15.3% total self-employment taxes that you're going to pay. So you have $100,000, you're going to pay $15,300 on that taxes for a construction partnership. In real estate, well, I should say also plus your income taxes, whatever your marginal income tax rate is. So if you're a real estate entity investor, so in that same partnership, you're not construction, now you own 5 rental properties, and it produces $100,000 of income. It is not subject to real estate taxes. So that 15.3%, you don't have to pay on real estate income in this scenario. So that's a huge savings.
So to kind of just rehash, so if you're in business, now you mentioned construction, but this goes really for any business, right? If I'm a real estate agent, broker, property manager, if I'm in if I'm in the business of really doing anything significant, then that's all going to be subject to self-employment income or income taxes, which is a 15.3% tax. But investing in rental real estate is not self-employment earnings, right? So you, like you said,
Correct.
if I have $100,000 from running my CPA firm, $100,000 of net income from running my CPA firm, I'm going to pay that 15.3% tax before I even talk about my marginal tax rate. But if I had $100,000 of net income from my rental portfolio, and this is $100,000 of rental income after all of the expenses, after depreciation, which we're going to talk about. But if I had $100,000 of net income from my rental portfolio, then I would not pay that 15.3%. I would not pay that $15,300 tax. So I get to at least avoid that. So right off the bat there, investing in rental real estate is going to allow you to build income streams that are not subject to Social Security and Medicare tax. It's much more tax efficient than being a business owner. Well, let's talk about one of the big tax deductions that everybody likes to focus on, and that is depreciation. So give us a rundown of what depreciation is and why it's beneficial to real estate investors.
Sure. Yeah. Depreciation is a very good area and an area that we should always focus on. What I want to I always throw this out to the new people I speak to is some people I get asked for real estate investors, why is my property being depreciated? I'm investing in these real estate properties because of the appreciation of my fair market value. So my always response is depreciation is really just a cost recovery method. So just like you would normally do any other, cash expense or for a true expense or insurance, you're going to get that deduction typically right away. For when you buy a full property, you're really just getting a cost recovery method over the deemed life the IRS sets forth. So I just always want to say that's really the purpose of this. It may appreciate in fair market value, but you're going to depreciate it from the cost basis side.
Yeah, a way that I like to explain this is that your roof, your windows, the components that go into your property are literally going to fall apart over time, and that's what depreciation is meant to track. So carry on with your depreciation explanation.
Sure, absolutely. So just to explain in general, so let's go back. Say you buy $1 million property. That $1 million is great, but not all of it is subject to depreciation. So you take that $1 million, you have to figure out first, split it between land and building. So typically you're buying the land plus whatever the building that is, the structure on such land or lot. So the three kind of main methods is we always bring forth to our clients how to split out that $1 million, what is land and what is building, is one, if you actually get a true appraisal of the property, you can use that appraisal to break out between land and building, or we call it improvement value. Or you can use the property tax card. So you're going to go onto the county's website or the locality, figure out how it was assessed by the tax assessor for property taxes, and split the improvement value and land value that way. That is probably the most common way because it's usually all public knowledge that you can always reference. The last method is you can really use is if you use a similar property appraisal within a local other building that is very similar type property or structure, and or a similar type property tax card that you can find, that if you can't use the other two, is usually kind of the default to go. So that's how you would split between land and building. What I want to say next, and this is where it opens up for more opportunities, is now you have it split. So just say simply in that situation, you have 20% land. So you have $200,000 land. That land does not get depreciated. So there's no expense to that. You'll use that basis for when you sell. But for right now, no depreciation. 800,000. Now you can depreciate that amount. But for how long, for how much? That's the question. So if it's residential property, it's 27.5 years. If it's non-residential or commercial, it's 39 years. That is not very lucrative at first because that's over a straight line basis. So you're recovering at 800,000, either over 27.5 or 39 years. That's obviously a very long time to recoup some of that expenses. So the one way around that is doing a cost segregation study. The cost segregation study is exactly what it sounds like. Is an engineer, if you do a full-blown study, is going to come in and try to segregate the cost of that improvement value of that building to figure out, is some of this building not 27.5 or 39-year property? Can it be reclassified or segregated to be 5-year or 7-year property or 15-year property? And what's the reason for that? The reason for that is obviously you're now, instead of taking over 27.5 or 39 years, you're accelerating that depreciation by either doing a 5-year schedule, a 7-year schedule, a 15-year schedule, or you can do a lucrative 100% bonus depreciation. So that can really advance a lot of deductions in this situation.
So let's talk about an example. Let's say that we have $10,000 of net rental income before depreciation, and we have $8,000 of depreciation. Talk to me about like how much cash am I actually receiving here, and how does that $8,000 of depreciation kind of come into play? Like, how does that help me?
Yeah, it's a very good question. So I always want to explain cash flow versus tax income, right? So that's always going to be different because of depreciation. So in that scenario, you had $10,000 of income, $8,000 of depreciation. The net there is obviously $2,000 of taxable income, but you've got $10,000 in cash flow from the rental. With these, the only part we're maybe missing there is any, debt cost that if you bought it, you might have to have some mortgage and stuff, which was usually less than depreciation overall and mortgage and interest. But from a cash flow, your cash flow is much higher than what your true taxable income is. This is kind of where the taxable income and cash flow really differ, and that's what really makes it lucrative in real estate.
Great call on that. So you have $2,000 of taxable income, even though you've received $10,000 of cash flow. And what I always like to think about is my effective tax rate, right? Because at the end of the day, it's not necessarily about eliminating my income tax, right? It's about over time, over a span of 10 to 20 years, how can I deploy the Warren Buffett method of investing? Warren Buffett pays millions of dollars in taxes, but why is it often cited that he pays less than his secretary? Well, it's because his effective tax rate, the total tax that he pays on all of his income, is lower. That percentage is lower than his secretary's. And so this is a really good example because I've earned $10,000 of cash flow, but I have $2,000 of taxable income. If I'm in the 37% tax bracket, that's like what? What is that?
Yeah.
two times three. That's like $700 or so, $700 of tax. So I've got $2,000 of taxable income, $700 of actual tax on that income, on that taxable income. But in reality, it's $700 of tax on $10,000 of cash flow. So my effective tax rate, even though I might be in the 37% tax bracket, my effective tax rate on this income stream is 7%, thanks to depreciation. So depreciation is tax sheltering this for me. Now, what happens if depreciation creates a tax loss? Like what happens if I have $10,000 of cash flow of income, but I have $12,000 of depreciation?
So it does depend a little bit, but basically it's gonna write down to zero. Obviously, you're not gonna have any taxable income, but now you have a taxable loss. So now this depends if you are a passive investor or a non-passive investor. So if you're a passive investor, that loss in this scenario, you had 10,000 of income, 12,000 of depreciation. So you have a loss of $2,000. If you're a passive investor, that $2,000 gets suspended and carried forward until you have any passive income to offset that, or you sell such property and it gets released. Only other way is if you have multiple passive activities, they all get netted together. So if you have a $5,000 passive income on one property, a $2,000 passive loss on the second property, that nets to actually only $3,000 of passive income.
And in listeners, you're going to be hearing about the passive activity rules throughout the summit. So if that just kind of overwhelmed you, don't worry. You'll hear about it on the short-term rental piece, on the short-term rental session, and then also on the real estate professional sessions that are upcoming. So we'll do a deeper dive into the passive activity or loss rules. But those rules, those passive activity rules, are the most important rules for individual real estate investors and landlords out of the entire tax code. So make sure that you pay attention to that type of stuff, because like Troy just mentioned, you can have this $2,000 tax loss and it can either be suspended or it can be used. It really depends on how you execute under the passive activity loss rules. Well, Troy, talk to me about depreciation recapture, because everybody always likes to talk about the benefits of depreciation and then they like to skirt over the actual recapture piece. So what is depreciation recapture and how does it come about?
Sure. So similar, you get your depreciation year one. You depreciate, say it's over 39 years. And so you're at the highest tax bracket, 37%. you're going to get a nice deduction, right? So you're going to get a deduction at 37% because you're lowering your taxable income because of depreciation expense. But say year 5. So now year 5, you're going to sell such property. If you have a gain on the overall property, you're going to have to recapture that prior depreciation that you took. But what I will say is that there's 3 different ways to recapture. And I'll explain this in a little more detail. So there's section 1245 recapture, there's section 1250 recapture, and there's unrecaptured section 1250. So this can be very confusing. So I'll take this as slow as possible for everyone to understand. This all comes down to the original way is section 1231 property. So that's what this real estate property is going to fall into. If you have a loss, you have 1231 loss, fine. If you have a gain, some of that gain can be basically recharacterized as those 3 recapture sections that I said. So for section 1245 recapture, and what I should explain, what the point of this real quick is, you get a deduction at that 37%. The reason you're doing this recapture is because this is an investment property. So typically any gain of any investment is at capital gain rates, 15% or 20% as of right now. The IRS does not like that because you got a deduction potentially at 37%. And now you're only recapturing it at 15 or 20%. That's a pretty good deal. So the way of them fixing this is doing these recapture provisions. So going back, so 1245 recapture, that's your 5 and 7 year property. So what that really is typically appliances and furniture. That's what it would be in that 5 to 7 year property category. So say you took 100% bonus on that recapture. On that gain, we're going to allocate that gain to 1245 recapture. That recapture is actually at ordinary rates. So you're not going to be subject to that capital gain rates at 15, 20%. It's going to be subject up to that 37%. So you still got a benefit of the time value of money of getting the depreciation in prior years, but now you're going to have to also recapture at the same tax rate. So I just want to make that known. The same thing happens for section 1250 recapture. That is 15-year property typically. So that's land improvements, fences, driveways, sidewalks, to give you some ideas of what would be in that 15-year property category. So same thing, that is also going to be recaptured at ordinary rate. So it could be up to that 37% marginal tax rate. The real benefit comes at the end, the unrecaptured section 1250. So what that typically is depreciation on that building. So we didn't cost segregate it out. That's anything that's 27 and a half years or 39 years, or anything that was not above straight line depreciation. So I won't go too nerdy of understanding that. But unrecaptured part of it, that is going to be subject to tax at ordinary rates up until the max of 25%. So this could be very lucrative in this scenario. Once you have unrecaptured 1250, say you had a deduction at 37%, you're only now going to pay tax on the gain up to 25%. So that is a 12% tax swing. This is obviously very, very beneficial that the IRS allows this. So just an FYI, that helps with time value of money still, but you also get the 12% swing.
So let's talk. Oh, I'm sorry. Go ahead.
I was going to say the last part is if there is no more recapture, the gain is above all these recapture provisions, the last part goes and is going to be taxed at section 1231 capital gain rates, 15, 20%.
Okay, so let's walk through 2 examples, and let's do example 1 first. So let's say that I buy a home for $100,000, and over the hold period, I depreciate it all straight line, 27 and a half years. I depreciate it $30,000. I then sell the home for $100,000. So listeners, it's important to understand I bought the home for $100,000, and the market was just flat for the hold period. Or maybe it went up and came back down, and now I need to get out of it. So I bought it for 100 and I'm going to sell it for 100, but I depreciated it $30,000 over the hold period. Troy, what do I have gain? And if so, how is that taxed?
Yeah, absolutely. So let's walk through it. So you had $100,000. That's what you received. That's what you sold it for. You bought it for 100,000, but you had the 30K of depreciation. 100 minus 30. So you have $70,000, the basis of your property. So you got 100,000, your basis is 70,000. You have a $30,000 gain. So now how is that taxed? So we can go into that scenario, but in your scenario, you said it was all straight line. So that is going to be unrecaptured 1250. So that gain, that 30K is going to be fully recaptured at ordinary rates up to 25%.
Got it. Okay. Very good. So it's important to understand that if I take depreciation, I'm going to have to pay that back, even if the value of my home has not increased. And again, pay attention as we talk about the passive activity loss rules throughout the various sessions, because if I was never like, if that depreciation created tax losses and I was never able to utilize those tax losses, I can use any suspended tax losses to offset that $30,000 of gain from depreciation. Now, example number two, let's say that I sell that same home for $110,000. So I bought it for 100, depreciated at 30. I'm selling it for 110. What are the various components of gain that I'm going to have to pay tax on there?
Sure. So same scenario. So you did 30,000 of depreciation. So our net basis, cost basis of our property is 70K, but we sold it for 110. So now we have a $40,000 gain, but only 30,000 of it is going to get recaptured because that was our depreciation. So same scenario, that 30K is going to be unrecaptured section 1250 gain, taxed at ordinary rates up to 25%. The other 10%, that additional 10% of gain, is now going to be subject to capital gain rate. So at 15% or 20% tax rate.
Very good. Very good. Thank you for explaining that. All right, let's move on to other deductions for landlords. So just in general, what are deductions that I can claim if I buy a rental property? Like, what should I be paying attention to and looking out for?
Sure. So your typical deductions other than depreciation that we just talked about. And I want to just real quick say depreciation is a use it or lose it. So make sure to always depreciate as a property because you're gonna need to, if you don't use it, you will lose it in the future. Other items, deductions you can have are mortgage interest. So you obviously pay debt. You have debt on such property. That interest is deductible. The principal is not. That's kind of done through the depreciation side. So your mortgage interest, you have any insurance, property taxes, those are all deductible. Also, any repairs that you're doing on such property. Certain those repairs will be talked about in a later session of the tax legal summit if it needs to be capitalized or not. But repairs will be allowed as a deduction. If there's a hole in the wall, you have to spackle it. That repair, deductible, simple, easy. Other simple, typical expenses are utilities. You're gonna have property management fees if you use a property manager. Those are all deductible. Any legal and professional fees that you're paying for your CPA, for lawyers, for attorneys, for setting things up, the LLCs, etc. Travel, home offices. We'll get to some of these in a little bit further details. What I want to explain though is how do you know if a deduction is actually allowable? So the easy way of understanding it is you can deduct anything that is ordinary and necessary for your business. So that's be a real estate. So what is ordinary and necessary? Anything that is current. What does that mean? So what does current mean? You cannot prepay your property taxes for 10 years. That's not going to be allowed. So obviously whatever is due within the next year. So just letting you can't advance deductions in certain scenarios. It has to be actually directly related. I can't deduct personal use on my business just because I paid it through business funds. So I also want to make that obviously very known. And then the last part is just reasonable in amount. So if anything that's outside of that's not reasonable, that's usually going to be disallowed as well.
What if what about the monthly property tax and insurance payments that I pay with my mortgage? Are those deductible?
So they typically will go into escrow. So the escrow is not it's not deductible at first. Is when truly those tax payments are due. So typically it's very nice service that these mortgage companies hold. They accept the escrow amounts for insurance or property taxes or whatever, but then they subsequently pay the county or local taxes. At that point in time, that's when it becomes deductible. The amount in escrow essentially will be deductible at a certain point in time, but it will not be deductible until it is actually currently due with whatever authority.
So it'll be deductible when escrow releases the payment. Basically.
Correct.
Cool. Now, what about guard dogs and lavish meals? Can I deduct those?
Guard dogs, No, I've actually never seen that situation before, but no, that is typically a personal expense. You're having a pet, you're not going to be having a true, there's no ordinary necessary reason for that. An alarm system, on the other hand, that to me is a little bit more of an ordinary necessary expense, not a guard dog. Lavish meals. Why are you having a lavish meal? Is it ordinary and necessary? And that's also a reasonable amount. If I'm taking out, an owner, of a person who's renting a property off of me, a tenant, that he's paying $1,000 a month. If we go for a $20,000 meal, is that really ordinary and necessary? Probably not.
I want
That's
to know
going
where
to
you're getting a
really,
$20,000 meal. That's incredible.
I'm going high. I'm going high. Oh yeah, but I'm just making it very,
Yeah.
very lavish. But yeah, that clearly is not ordinary and necessary.
All right, good stuff. What about home offices and cars? And I always hear people ask like, oh, or they're fearful of the home office deduction because they think that it's going to create like an audit flag. So talk to us about the home office deductions and writing off vehicles.
Sure. So home offices and vehicles are very great areas that you can kind of plan for, but you want to make sure you plan ahead of time and are well informed in these areas. So home office is really nice, but you need to have your home office. You have an office. I'm in my home office right now. But your home office needs to be used regularly and exclusively for a principal place of business, and also regularly and exclusively as a place that you're going to meet and deal with patients, clients, customers in the normal course of business. So if you don't have an area that you do, so if you have a home office, you call it your home office, but you're in there doing personal things. Your kids are using it for school. You have a W-2 job using it for, as well as your outside business. That is not exclusive to a trader business, so that is not allowable. So I just want to explain that right off the bat. Some people think they have a home office because they do have a desk and a computer in their home. That necessarily doesn't mean that it's truly home office in the eyes of the IRS. So that's the first way of just making sure you're understanding the home office. But it's important to create that, because now you have a principal place of business as your home. So your travel to and from real estate, your real estate investments, can now be deducted. So I'll go into the vehicle side in a bit. But going back, for home office, there's two methods to use for home office. You have your safe harbor. Safe harbor is easy. You have $5 per square foot. I have a 100 square foot home office. $5 times 100 is $500 deduction. Other way is actual expense method. So going off before, you have depreciation, utilities, insurance, interest, etc. But for your home office, you can only allow the deduction for the actual home office, the actual business use. So make it really simple. So you have $1,000 square foot home, 100 square foot is your home office. That's 10%. 10% of all utilities would be deductible on my home office. Does that make sense? The last part is also anything that's directly allocable to that space, so that square footage. So I have a repair in my home office, that's going to be 100% deductible, not subject to the business use requirements.
And what about vehicles? When can I deduct a car?
Yeah, so a vehicle is actually very similar to the two methods that we talked about. There's a safe harbor method, or the mileage method, or the actual expense method. So from the IRS side, you're going to want, for the mileage side, sorry, you're going to want to do, it's going to be for 2022, it's 58.5 cents per mile. So you're going to want to have a compliant mileage log. So if you need this for both methods, for the actual expense method and for the mileage, so you want to figure out what is truly a business mile, or a business mile versus a personal mile. So one simple way, or a good way to be compliant, is you're going to need an odometer at the beginning of the year, odometer at the end of the year. That knows how many miles you drove. And then after that, you need to put a purpose. You have to log showing the purpose of your miles, how many miles, the locations of your trips, and basically proving out why it is truly a business mile. You're going to need this for either method. One way to do this, because this can be burdensome, an administrative burden, help yourself by using a tracking apps or an Excel spreadsheet. A tracking app is, Mile IQ is a good one that we like to reference. But please use that to help you facilitate and make your life easier. But going off those two methods, the mileage is simple. You drive 1,000 business miles, you get 58.5% of all those business miles. What I will say is that where you typically get a bigger benefit is the actual expense method. If you do the actual expense method, that is simply you're going to take also depreciation, your lease payments, gas, interest, repairs, insurance. But at the same time, you have to figure out what your business use is. So if you use out of that scenario, if you only use it for 60% business, out of all those expenses that I just referenced, only 60% is allowed to be deducted. And you're going to have to, if the IRS ever audits you, you're going to have to basically prove. Burden of proof is on the taxpayer. That's why it's very important to have these logs and keep receipts. So you want to be able to prove it easily, provide it to the IRS agent, etc. We also like to ask to get our taxpayers or our clients prepared in any of these situations. So I just want to make sure, try to be regularly doing this, so you don't have to retrospectively doing that, because the IRS doesn't like that either.
Great. And if you're wondering, can I write off the cost of a car that I just purchased? We're not going to dive into that on this session. I think it requires a pretty detailed explanation. But just so that I can give you that information at a very high level, if you are a small landlord, the answer is probably no. If you're running a business where you need a vehicle, the answer is probably yes, and that can include being a larger landlord as well. So make sure you do touch base with your tax advisor if you are thinking about purchasing a vehicle, because it can be a pretty lucrative tax deduction. Well, tell me about education expenses. We get this question a lot. Let's say that I'm studying for my real estate agent exam, and I've got to buy all these books to study for it, and I'm out $500 or something. Can I deduct this $500 cost? And let's also assume that this is my first foray into real estate.
So the short answer is no, because and there's a treasury regulation that I won't quite fully reference, but basically education is only deductible when the expenses are used to maintain. So that's the key word here: maintain or improve the taxpayer's skills in such trade or business. So if you're new to this industry and you're not inside the trade or business of real estate, those, just like you were saying, the books and stuff for real estate exam, you're not in the real estate, and you're not really maintaining your skills because you're not inside the real estate business yet, and you're not improving it. Maybe you're improving to get into it, but you need to actually be in the trade or business. So that's not deductible. But going off that, if you have an existing trade or business and you're taking a real estate course, just like you are paying for the tax and legal summit, that course, if you have 10 rental properties, you are now utilizing, you're taking this course to maintain and improve your skills. That is allowed, and that is deductible.
Perfect. So the tax and legal summit fees, if you purchase the VIP tickets or the recordings, can potentially be deductible if you're already in a trade or business related to real estate. And in a trade or business is being a landlord, as long as you own your own properties. If you're just investing passively in LP deals, there's a good argument to be made that you're actually not in the trade or business of real estate. So just be careful with that. Now, if I'm a landlord and I'm listening to everything that you just said, I'm just like, whoa, man, that's a lot of information. Where can I go to remind myself very quickly and easily what expenses are allowable, at least at a high level? Is there a particular form that I could look up that would just list it all out for me?
The easiest way is, just going right to the tax forms, and that's going to kind of explain kind of what typical expenses there are, at least what the IRS has already deemed or actually segregated out on a form. So from an entity side, the partnership, S Corp, et cetera, you're going to go to form 8825. That's where it's going to be reported on the tax side. If you are going to report on your individual returns, so your 1040, you're going to go to your Schedule E. That's where you're going to put rental properties. And that's where you can basically look and see kind of the items that the IRS has already deemed appropriate, or give you some ideas of what are proper expenses there could be for such real estate.
And you can Google these forms too. So you can literally type in IRS Schedule E or IRS 8825, and it'll take you right to those forms. And then on the left-hand side, it's going to show you all the kind of basic expenses, that you should be tracking, which I think is a really good, just quick and easy reminder. Where do I report flipping activities?
Yeah, good question. We get this question quite often. So flips, I like to just explain what that is. You have to think about flips is really almost like you're manufacturing, usually obviously rehabbing and flipping such property. It's really like you're almost manufacturing or improving something and selling it. So it's really inventory. So just like you would be creating widgets or anything else you manufacture, you're creating it, it's your inventory until you sell it. So that is really more of a trader business, not necessarily a real estate investor or a rental property, of course. So that's going to be reported. If it's in a business or partnership or S corp, it's going to be on page 1. So that's really your ordinary income. And if it's on a individual return, so on your 1040, you're going to report it on Schedule C.
Okay, and
So
let's say that I buy a flip at the end of 2021, so December 2021. I spent $100,000 acquiring a property and improving it, and then I sell it in March of 2022. When do I get to deduct the $100,000 against my income?
You're going to deduct, so it all goes off of the tax year. Tax years are typically your calendar year. So you bought it in 2021, but you sold it in 2022. Just like if you manufactured something, it gets stuck in the inventory at the end of 2021. So it's not deductible in 2021. You can deduct it when you sell it in 2022.
Makes sense. And we have actually seen quite a few instances where people will deduct the $100,000 even though they still own the property going into the next tax year. So you got to be really careful with that. All right. If a real estate investor wants to maximize all this, so they're hearing everything, they're like, okay, what do I need to do to position myself to take advantage of all of these potential deductions? What's your recommendation?
Well, since you're listening to us speak right now, that is the first step right off the bat. So plan early, get ahead of the game, be informed. That's the easiest way to start, right? So plan early, be informed, get good accounting and bookkeeping systems in place. If you're buying your first few properties, you want to make sure you get that in place early. If you already have 12 properties, it's hard to go back and retrospectively change it all. So try to plan early and get ahead of the game. Same thing, keep receipts. Be very organized. Be very on top of all the receipts that you're going off. Same thing with logs. We talked about mileage logs. If you want to be a real estate professional, make sure you have your logs in order. So those are main things that you want to make sure to do. I would say the last thing to do is get great advisors. So that's why you're also speaking with us. Reach out, get a great CPA, get a great attorney. They will lead you in the right directions. They will give you the right information, the right advising to help you maximize all these deductions.
All right, Troy, thank you so much for coming on and speaking to everybody today. Where can people find you?
Sure. So you can reach out to our website at contact, at Real Estate CPA. You can reach out to me directly. So Troy.Silfies, Silfies, Silfies at hallcpallc.com. Reach out to me directly, or you can always look me up on LinkedIn and message me on there. I welcome everyone to, if you have any specific questions, please reach out.
Awesome. You dropped a ton of knowledge today. Thank you so much for coming. And folks, if you enjoyed this session, you can purchase all of the session recordings at recordings.taxandlegalsummit.com at any time throughout the summit. So we will see you back here in about 15 minutes. Thanks so much.